Welcome everybody to another 12 property days of Christmas. And today we are joined by the fantastic Richard Bowser, editor of the Property Investor News magazine. Now, Richard, I've known you quite a number of years, and I've always been hugely impressed by your analysis and grip on the market, your forecasting, and what the trends are likely to be. Now, with the best will in the world, I actually saw, I think it was your very last presentation in Watford, uh, the
That's
day
right.
before
Yeah,
lockdown,
the
wasn't
day
it?
before lockdown one. Yeah.
Now, who could have predicted 9 months later, London's in tier four and the rest of the country's in various states of a lockdown?
Yeah.
So I know David and we did forecasts in 2020. What's your predictions of 2021? What does it look like for property investors? Is it a good year ahead or a mixed bag?
Yeah. I think that's I think first of all, I would say, putting it into football terms, it's not going to be a game of two halves. I think it's going to be a game of three thirds. And the first third is going to be, for a lot of people, surviving, just getting through until Easter. And from what we know so far, the vaccines being effective and increasingly rolled out. There was some PR at the weekend through the Telegraph that 27th, 28th of December that the Oxford AstraZeneca vaccine, which is produced not too many miles away from where I'm currently, will get the go ahead. And obviously that will be a real boost because of its efficiency, storage, etc., relative to the other two current candidates, Moderna, Pfizer, which is obviously being rolled out. My stepmother was fortunate enough to receive it on Friday, the first jab. So I think the first third of the year is going to be the tricky part, and obviously what we're seeing at the moment, it's bizarre really, because this magazine we've just produced, which is our December edition, and I make reference in my editorial comment to queues of HGVs at Dover, etc. Well, of course, I hadn't anticipated that this new variant strain would cause the queues that now we have, and obviously that's going to add just once more to the uncertainty that we're seeing. But we can talk all day about COVID, but for me, it's a bump in the road. I think in 5 years' time, I think we're going to look back on this, and it will be seen as a blip in the road. That is the way I feel about it. I think that's the way you've got to feel about it. Certain things have changed. Obviously, technology has really, as we're doing this morning, showing us what can be done. And obviously, there's been innumerable examples since the last physical meeting that you referred to, Andrew, back in those strange times, BC, before COVID, etc.
We were all shaking hands with our elbows and feet,
it was a bizarre experience. It was, I tipped up to do a talk to about 25, 30 people. The entire hotel was, it was tumbleweed. There was nobody there at all. I mean, clearly very, very few people staying. And Alok and Jazz did the meet, and yeah, but it was all very surreal. I went back to my flat in Highgate that night, and I was listening to on the radio saying about lockdown. I thought, oh, let's get out, let's do what I've had to do. But turning quickly to the property investment, so I see it as three thirds. I think the second third, to some extent, with the residential market, is going to be dictated by the cliff edge, which is approaching in respect of stamp duty, SLDLT, and the holiday, and the impact of that. And obviously, we know that that's already looking to cause chaotic situations with conveyancers trying to get stuff through. So there's going to be probably, unless they extend it or do something, government, there's going to be problems there. The second part of the second third, I would say, relates to obviously redundancies. Government again has extended furlough by another month. Rishi, I think that's the one real thing that they have absolutely pretty much got right. Obviously, there's 2 or 3 million people that would disagree with what I've just said, that have fallen through the gaps. And, I think the level of support compared to 08, 09 is to use that much overused word, totally unprecedented. And as I've said on a number of occasions, obviously my grandchildren will be paying for this. But hey ho, we are where we are. But at least we don't have the prospect of Jarrow type queues from the 1920s, late 20s, etc. Most people are receiving good level of support. It's interesting with this tier 4. I was just reading this morning, that they're continuing to allow trades to go into people's home. They're continuing to allow the residential market to act pretty much as normally. Rental and property transaction sales, we've got one going through at the moment. Loads and loads of viewings. We've had offers. So it'd be interesting to see how that plays out over the next few months, obviously. So just trying to tick these things off. For the second, third, I think the redundancies, the stamp duty cliff edge, that's then going to impact. So we're talking about risk v opportunity. And obviously those things are going to lead to opportunities. If there is a big cliff edge ahead with transactions, then obviously it's going to be to some extent in terms of potential discounts. But just because something is cheap doesn't necessarily mean that it's good value. And I think that can also be applied in the commercial property sector, where we are all well aware of the trends that what we have seen, the outcome from COVID, the Zoomification of communications, businesses not needing offices. And I think this is going to be a genuinely long-term impact. Certainly city centre offices. Again, we've covered this in the magazine and others extensively. But last week we put a news item out, and it's reported in this December edition. And by the way, I don't know if you can see the sort of
No, we can certainly see that
here about the and I'll read it. It's 90% protection for landlords against Brexit, COVID-19, councils, and HMRC. And of course, one of the reasons we mentioned councils in one of the lead articles in this edition is about council regulation, etc. So yeah, I mean, I'm trying to just give you as much info in as short as time as possible about what I'm seeing. So I stick going with this 3/3. I think through until September that'll be the last third, and then by then hopefully a proportion of the vulnerable or all of the vulnerable, and hopefully there are no unexpected with the vaccinations, and then we will start to see normality return, hopefully, and then hopefully by the end of the year.
So we've dealt with the C word, Richard. Can we move on briefly to the B word, Brexit, which at the time of recording this is looming ever closer? What impact do you think that might have on the property market in 2021?
You heard it here first.
I mean,
on the Great Property Meet, 12 days of property Christmas.
I mean, I've been waffling on about this since 2016, and I still come back to the sentiment that I expressed in the July, I think it was, edition after the referendum, that at some point one would hope that common sense will prevail, and that's not forming a judgment on anyone's particular take on whether it's a good or it was a good or a bad thing, etc. But yeah, I mean, the sheer weight of, with this, to undo whatever it is, 50 years, 48 years of trade between us and the bloc, with all, it's going to take a lot longer than so.
Yeah.
And as far as
I think Barack Obama, Richard, came out with some good statements over the weekend, which were along the lines that the project appeared to be working well, but then splinter groups started to appear in it because it was starting to lose its common goal. You've got the Hungarians, the Dutch, and others who were all sort of expressing dissatisfaction. And the more it's got centralized in Europe, and things like Greece, the more it's become difficult for Europe to actually run itself, because Angela Merkel and Sarkozy were trying to sell to their people the Greek debacle and why they should bail out some foreigners, as it was put.
Yeah, but also we've had for quite a number of years, including the Hungarian situation, a leaning towards the right. We've seen it with Le Pen in France, etc., etc. But I just think we, from a UK perspective, irrespective of what was happening on the continent, which has impacted, that whole, we know why. I mean, I don't go into this because some of it's quite sensitive stuff, obviously, and people won't necessarily agree with what my personal thoughts are. But we are where we are, and I just think, we've got to, when we look at the reality. I mean, the reality is, of course, from a currency perspective, we are currently quite a lot poorer as a country. Our buying power has been considerably reduced in the last 4 years, and that has a knock-on consequences. Never mind what it costs you for a glass of Bordeaux when you go over to France or whatever. There are consequences. But as far as what might happen, this, only if I've just referred to it in the editorial for the December edition, it's been a long-term game of chicken. Who's going to blink first? And at this moment in time, it would appear, barring some politics in northern France around Boulogne and the impact on fishermen there, which is obviously going to be quite considerable. And you have to understand their position, from a French perspective, and also that the politics in France are playing as well. So, but you would think that these things, with some statesmanship, will be resolvable. And hopefully this prospect of a cliff edge no deal Brexit and going to world trade, etc., will be resolved. But at this moment in time, I'll do what I did at the beginning when you asked me about that. I don't know. We just have to, common sense will prevail. So
you heard it here first. If you disagree with Richard, drop a comment below, and we'll all jump on and tell you what our thoughts are. But Richard, I mean, you speak to the great and the good in the property industry. You're always networking with people who are at the top of their game in residential, the top of the game in commercial, the top of the game in development. You're also on the Property Investor Awards judging panel.
Yeah.
What sort of key highlights do you see in the residential, commercial, and development sectors over the coming?
So as far as residential is concerned, I think the whole move towards a professionalisation of the sector, I think, is a strong one. There's absolute huge amounts of money being flooding into build to rent, going into co-living, which is the sort of side. When I say co-living, I'm not talking about some of the way that it's been adopted by smart HMO operators to differentiate, but I'm talking about the big stuff. The sort of the resi merchant stuff. What we're talking about here, the large scale. Purpose-built blocks where the emphasis is on community, the emphasis is on communal service, lounges, all that type of stuff. And I think that is going to grow and grow. And therefore, individual residential small-scale developers whose focus is build and rent out, they're going to have to be more professional. If you've got to compete maybe with your block of 8 or 10 or 15 or 20 units against someone that's got 350, and therefore, but of course the pricing is the other thing as well around build to rent. It's the availability of land in locations where young people, and generally up until now build to rent was focused more on the young, on the postgraduate market. And of course the impact of urbanisation is also going to be the interesting one. That's one of the main topics in the December edition, urbanisation, this whole, city centre living, the suburban living, the people wanting more space, people only needing maybe to go to the office 1 or 2 times a month. Therefore, you can live pretty much wherever. I mean, personally, I'm considering moving to France at the end of next year for half of the year, and I'll still be able to, using technology, run my business. So yeah, all of those things are going to play out, in my opinion. But obviously there are question marks at the moment. Okay,
and commercial marketplace. Clearly offices have changed over the last year, as you're intimating, and the retail high street has changed significantly. Is there shall we say, the planning white paper and the new
Yeah.
permitted development rights, do you see them having a helpful or hindering factor on the commercial marketplace and development marketplace?
Yeah, I mean, I think with commercial, you know, the whole PDR, permitted development. I mean, first of all, let's just take you going back to what I've just said about urbanisation. So in the week, I live in a flat in North London, and I'm in a very nice part of North London. I've got a village effectively on my doorstep. I've got every facility that I need within literally 100 meters. I can order anything 24/7. And yet here I am talking to you today where my nearest retail shop is 5 miles away. So I see both sides of it, but at the same time, I can switch my attention. I can be on my iPad or whatever, and I can have something delivered tomorrow morning. And you know, that's only going to become that in itself is going to also evolve. I did an interview with the head of Deloitte a couple of years ago in London, and he's also the head of the China office, and he was telling me then 2-3 years ago that in the 6 main Chinese cities 2-3 years ago, you could order online and get it delivered within 3 hours.
Wow.
That's then. So where are they now? Where are we going to be now? What's going to be the impact of, for example, auto delivery via drones? This stuff is all being tested. They're working on, as I understand it, 1.5 kilo drone delivery. Are the skies going to be filled with drones buzzing around, dropping stuff in your driveway or on your rooftop, etc.? And therefore, what's going to be the impact of that on commercial property? Mm-hmm. But just going back to this analogy from town v country with suburb, what we've seen this year, obviously, is suburbs have become more in demand. Suburbs with good shopping facilities, community-focused activities, outlets which are shops which are more service dependent and people dependent, hairdressers, etc., etc. They're good covenants to have, probably. Whereas, you know, certain types of sectors which are obviously much more vulnerable to Amazonization, online delivery, they're more at risk. Hospitality has been massively impacted, as we know, and obviously London again, with Tier 4. I've got 2 pubs in my local high street that haven't opened since March, and probably one of them definitely won't open. Repurposing, you mentioned PDR, absolutely. I think that there's going to be a lot of it. But the one thing I would say to people, there's obviously a lot of talk, a lot of comment about permitted development rights and these latest changes that have come out of the blue in the last few weeks. We did a couple of workshops on them earlier in the autumn, but there's a whole raft of stuff to be delivered around Class C and the way people will be able to transition very easily. But you've got to think of who's going to be your end user. Absolutely. You know, your ability to convert something is all very well, but if it's not going to attract an end user that's going to pay, has got a business which is going to work in the then you've got to be careful about. So really choosing your occupier, your commercial occupier, irrespective of what you're going to do with the uppers, you know, converting, etc., etc. I think it's the you know, you've got to think
critical.
about that.
So coming back, Richard.
In mind.
Yeah, coming back, Richard, to what you were saying at the beginning about this COVID being a sort of short, sharp shock and the country sort of recovering in a whole in 3, 4, 5 years. How do you see city centres looking when we eventually emerge from all of this meltdown?
Yeah, I mean, I didn't actually follow through on a point I was going to make about this particular edition, and what I was referring to there was the announcement last week about Bishopsgate Goodyards. Now, probably a lot of people won't know it, but I remember it from 20 odd years ago because I used to park my car under it. And it's a 12-acre site at the bottom end of Shoreditch High Street, where there's going to be a massive development, 11,000 jobs created, you know, 2,000 homes, X 100,000 square foot of office space. That's right on the butt of just down from Liverpool Street in London. Now, you know, there's billions going to be invested in that. So that's a city centre location. Now it's going to be mixed use, and I think absolutely what we're going to see is repurposing of some of these larger buildings. I mean, once COVID is hopefully over, you know, clearly at the moment, who wants to get in a lift to go up 50 or 60 floors at Canary Wharf or whatever? And that's going to have a huge impact. But of course, you know, what's happening is that these large organisations are not staffing their offices. The likes of Barclays said, look, we'll see you next summer or whatever, so they're paying their employees. So, and that's not just UK, that's going on all around the world, as we know. So I think this, the repurposing, the readapting of city centres, but we are social animals. Young people want to come together. They want to integrate. They want to wine and dine. They want to, understandably, you know, Thursday, Friday, Saturday night, do what they do. And you know, what the heck, there's nothing wrong with that at a level. So David, to answer your question, I think there will be some change, and technology will also drive that change. But I think we're going to see much more mixed use adaptation in the years to come. And again, the buildings will be more, they'll be more multi-purpose. That would be, and it's how they're adapted, multi-purpose. You know, it's the same with the huge high street stores, the likes of these Debenhams and whatever, that are obviously now dining stores in terms of their use, and which is why we're seeing what we're seeing in Arcadia, etc. So I think we will adapt. Yeah, the buildings are there. Some of them will not be adaptable. There may be, you know, depends. You know, I think it was either 2 weeks ago. I think the first big House of Fraser or Debenhams, I can't remember, the one in Guildford, but that's now being it was a £32 million investment announced by a group, and again that's going to be multi-purpose, but obviously most of it will be residential because that's the higher per square foot value, which obviously is logically what a developer will go for. You know, why would you not? You're going to go for something where the highest per square foot value is going to be achievable.
Well, I think, if I'm not mistaken, it was Property Investor News. I read it a few months back that the John Lewis Group had set aside something like 300 million to redevelop some of their sites to become those multi-purpose that you're just explaining. Now, one thing that I always get from you, and it's brilliant, is you're normally analysing the market by regions, by areas, north, south, and sort of looking at the trend lines where things are going. Now, this post-COVID, post-Brexit, post-furlough type environment, what do you think might happen in terms of north-south divide? Do you think the better quality of life up north might pull people in? Or do you think, as we've seen with a number of shopping centres that have been on near, some over 50 and some over 40% yields, which have basically got tumbleweed blowing through them, is going to put people off on that north-south divide?
Yeah, I think, well, obviously, you know, sorry, I'm moving those things. Clearly, if we look at the likes of Savills and what have you, the forecast for the next 4 or 5 years, what we have been seeing is for the Midlands and the Northwest in particular to be the strongest locations in terms of demand and therefore growth. One of the things which people maybe don't necessarily grasp in terms of long-term occupational trends is demand related to what's the term I'm trying to think now, in terms of demographics, in terms of depopulation, and you know, there are some areas in the UK which are not particularly looking that positive in terms of demographics. In other words, they're locations currently where more people are likely to leave each year, or it's stagnating population, and that is the big driver. So, you know, investment, obviously, I mean, again, we're entering onto politics now a little bit, but you know, this current government got in on the back of levelling up, of the red wall, etc., the fragmentation red wall. What are they going to be able to deliver on that post-COVID with you know? So getting but successive governments over many decades have tried, you know, made noises about levelling up, have tried to pump money into the regions, you know, Northern Ireland again, Wales, you know, and great intentions, obviously good intentions, but the reality of it isn't always match up to the political rhetoric. You know, we had the, what is it, trying to trying to think, there's a term, but anyway, there's sort of, the investment up in the region across the Pennines. There's still this question mark over transport, communication, the need to get HS4, that's the Trans-Pennine high-speed route, which a little bit like Crossrail 2, it's obviously now being kicked into touch a little bit in terms of priorities, understandably. Saving lives has become the order of the day. Yeah.
Well, also, who wants to jump in a tin can and travel at speed in close proximity to others at the moment?
Well, again, that is, yeah, quite. Well, lots of people did on Saturday night, it would appear. So,
Okay.
looking at the views of St Pancras, which obviously have received a lot of negative publicity. I mean, that was
Yeah.
But yeah,
well, if you're going to cause a virus to spread, let's create panic so everybody runs.
Yeah. Yeah, I mean, government, I wouldn't want to be in their shoes. I mean, whatever they do, they
damned if you do, damned if you don't.
Absolutely,
it's a no-win situation.
Yeah,
absolutely.
We can be wise sages on these sort of things.
Oh yeah, it's great.
Hindsight.
Criticism in hindsight is great, isn't it? It's it's I think.
Now, interestingly, this stamp duty holiday also will have had a disproportionate effect in the north and in the south because of the disparity in property values. So could that have a sort of knock-on effect in 21 as it comes off?
Yeah, well, obviously the 500,000 is a significant factor where the average value in is 480 or whatever it is.
Yes, exactly. That's my point.
Whereas but as I said to my wife, funny enough, in the car yesterday, what we've seen in this slightly unexpected trend that we've seen since June, when obviously to some extent the stamp duty was petrol on the fire of suppressed demand, but that would be my take on it, in terms of what people then aspired to do and then did, bid and bought, etc. It's already in the price, isn't it? This 15,000, it's already in the price now.
Yes.
In terms of, so that needs to be thought through. Whereas up in the northeast where I've got rental properties, 500,000 is well, it's
a portfolio.
Yeah. Well, it is. Yeah,
I say that not to be rude to your portfolio at all, Richard, but
some of the ex-pit villages, that'll buy you 10 properties.
Yes,
whether you find, whether you'd find enough paying tenants that are not going to play around, and anyone that thinks that's a land of milk and honey,
another
thing in the dream world.
Absolutely.
I could regale you with a few sales that I've experienced over 20 odd years of operating in that environment. It can work, and it's worked very well for me, but it's not, it's not. It's not exactly plain sailing. Yeah.
No, absolutely. So to draw this to a close, is there any piece of advice or pearls of wisdom that you'd like to sort of impart, where at the end of this year, if you haven't done this, or if you've done this, good news, is there anything you'd like to sort of part with?
Okay, I mean, I just keep going back to something I've been saying for quite a long time, and that's focus on demand and sustainable demand. And too many people, and I said this in a big webinar the other week, you probably know what I'm talking about, there's 1,000 odd people on it, but people get hooked on the whole, well, we can do this and we've got permitted development rights and that's great, and buying below market value and doing this and doing that. But at the end of the day, if you haven't got a solid occupier, then it's all smoke and mirrors. And a lot of people started off 12 months ago with the idea of 2020. I remember we were doing, and I'll just give you an example, when we were doing the judging for the Property Investor Awards, and one of the award categories had the most amazing entry in terms of end finish. It was absolutely stunning, this property. We took a judgment call on it as a collective, the judges, and said, well, it's fantastic, but we're not judging a design award, And where's the evidence that this is a sustainable property in terms of end user demand? Because this is just being created. So we basically said this would be a great one to bring back in 3 years' time once the business case is proven. So two things. Absolutely, you need to take as professional an approach to your property investment activities as possible, and absolutely focus on demand, because there have been lots of people this year that thought that they had a serviced accommodation business which was robust, and unfortunately it's not been proven to stand the test of the times. So obviously, you know, this has been exceptional, but 08 was exceptional, and you know, these
each one of the speed bumps is always exceptional.
Yeah, stuff comes along,
Yeah.
and you've got to be prepared. And again, where most over 20 odd years, you know, almost 20 years of publishing property investor news, where people go wrong is they get carried away in the upcycle, they stretch themselves too far, and then they're exposed, and just a puff of wind blows them over. So, you know, most of the people in my network who are long-term players with really good portfolios, they're always looking at de-risking. They're always looking to deleverage. And obviously, the older you get, the more you're wary of excessive leverage. But I've got a subscriber down on the south of England. Let's just say the south of England. He's got 500 odd properties, no finance, and he's been doing it for 60 years, and his, you know, he was buying stuff in the early 60s in locations where now he gets 2 or 3 times in monthly rent what he paid for the property in the first place. But it's just about being sensible, and so that you just making sure that, you know, as this stuff comes along, these events, because that's what they are events, and obviously we've had a big one this year, that it doesn't knock you over, and you can survive to get through into the next upcycle, and expand, and be sensible about your gearing, be sensible about the risk taking, and yeah, get through until the next puff of wind or whatever it is.
So I think to summarize, the advice would be buying below market value is fine, provided that there is a market for it, and it's not below market value because no other fool wants to buy the property. And de-risk and deleverage your portfolio in order that you can survive the sandstorms that might be bustling around you at the time.
Yeah, absolutely. I mean, I've got another tip for people to think about is, you know, a certain stage, you know, target each year maybe to knock a percentage point off your loan to value.
Yeah, no, that's.
I've got subscribers with big portfolios who operate on that basis. You know, they're in their 40s, heading towards their 50s, and their gearing is now below 50%, and they're heading towards 40. Maybe below 40, you might say, actually, that's about as safe as you need to be. But yeah, it's all about, yeah.
It's always about looking at it. If there's a storm in a teacup, 2008 was a financial one. What the lenders were doing was looking at where the greatest exposures were. So they called in the 75% loan to values, then the 70s, then the 65s. You want to be as far down that list as you can so that the storm is dissipated before they come knocking on your door.
Yes.
Very wise advice.
Sorry,
there's also a good case, isn't there, for keeping a cash float in your business, which I've always been in favour of having, you know, 3 to 6 months again, perhaps in view of what's happened in 2020, a bit longer. Yeah,
no, absolutely. Having that war chest is, you know, okay, at the moment it's going to earn you diddly squat in the bank, whatever it is, or virtually. So, but having it in relatively safe, accessible. You know, a tip I've always had it, you know, and always is to have at least one unencumbered property, mortgage free, so that if you need to, if either a disaster occurs or an amazing opportunity comes along, you can get some fast bridging. You've got to pay a price for that bridging. But if the opportunity is strong, then why not? And if you can then refinance out of it within 3 or 4 months or whatever it might be, then you're back to having an unencumbered property. So yeah, a good war chest and an unencumbered property, at least one, no bad thing to have.
Well, I asked for a pearl of wisdom, and you've actually given us 5 pearls of wisdom there in the end, Richard.
Well, helped by David.
Congratulations.
Yeah.
So all that remains for me to say is a massive thank you for sharing this with the property community at large. And I'd love you all to give Richard a big thumbs up, drop him some comments, tell him if you agree. If you don't agree, why don't you agree? And we look forward to seeing you this time next year when we shall repeat the 12 property days of Christmas. Thank you very much, Mr. Richard Bowser, property editor of Property Investor News, the de facto trade property newspaper or magazine. And
Thanks, David. Thank you, Andrew.
You're most welcome. Thank you.
Thank you.